Welcome everybody to the first lesson in my day trading course. This one is going to be on reading and interpreting price action. Some of this is pretty foundational knowledge, but I suggest you watch the entire thing all the way through because I talk about things in a slightly different way, and this material is all going to build off of itself going forward. So a quick overview of what we're going to be covering in today's course. First off, just simply how you read candlesticks. We're going to talk about why you use candle charts over traditional standard line charts. I'm going to talk about kind of the important single candle types, and then we're going to talk about multi-candle patterns, what I call the 4 C's of price action. I'm then going to briefly cover multi-timeframe analysis, which is a topic that'll be in all of our lessons pretty much, and I'm going to give you an introduction to the idea of support and resistance. So with that, let's get started. So we're going to start out super basic with just how you read candlesticks. Each candle is made up of 4 parts. The open and close are represented by what's called the body of the candle here, and then the low and the high are represented by what are called the wicks of the candle. Each of these candles here can represent a single unit of time, anywhere from, let's say, 1 minute to a year to a month, basically any period of time that you want to represent on your chart. You can have a candlestick chart for that time frame. Candles are extremely important because they represent the auction process that took place during that time frame. So if you look at a single candle, let's say a green candle, the opening price is down here. At some point, it traded down to this low. It traded all the way up to this high, but ultimately it closed into the time frame at this level. That gives you a tremendous amount of information for interpreting what auction is taking place and what the market sentiment is. So before we move on to more detailed information about reading price action, I wanted to quickly show you an example of why we use candlestick charts over traditional line charts. If you look at these 2 charts, both are of Apple, and I've highlighted the same daily time frame on each. You can see that on the line chart on the left-hand side, you only have the closing price for each day. So you just have a single piece of information, and you really don't have any way to tell why this price would have rebounded off of the 160 level. But if you look at the chart on the right-hand side, you can see that each one of these candles represents the information that we tried to sell off below 160 basically every day of these 4 days, and we failed. Buyers said no, value is higher. Every time it sold off all the way down to 154 at one point, we bought back up. Don't worry about what each of these individual candles means. We'll go over that in the following slides. But just take away the information that this gives you so much more information about what the market sentiment is and what the auction process is doing than this simple line chart. I think it's pretty obvious when you look at them side by side, but just wanted to make that clear before we move on. So now we're going to go over important single candle types that you should be paying attention to as you try to read and interpret price action. Candles, as we've stated, are super valuable to the trader because they give you additional insight into the auction process and what the market sentiment is moment to moment or hour to hour. No single candle can be used to determine what the future price movement is going to be, so don't try to read it in that way. However, certain candles are inherently bullish, bearish, or neutral, right? And so you can see what's happening in the market, whether it's bear bull candles, which show you clear directional sentiment, Doji candles, which represent indecision in the marketplace, or hammer candles, which represent a potential change in sentiment. So each candle, as you take it in turn and interpret it, should kind of give you one of these 3 feelings. Either we're in indecision, potentially we're changing course, or we're strongly moving in one direction. The first set of candles that we'll go over are bear bull candles. These are candles that have a closing price very near their low for a red candle or very near their high for an up candle. Personally, I use the color white to represent an up candle and the color red to represent a down candle. But for bear bull candles, the important thing to remember is that they are inherently, at face value, very strong signals that the market has decided that value is either higher or lower than the opening price of the candle. So if you take a look at this 15-minute chart of NEO, for example, you have a strong bull candle here, where the opening price is the same as the low of the time frame, and the closing price is extremely close to the high of the final 15 minutes. You can also see this on a daily chart of Apple, where you have days that open down here and then close all the way at the high of the day. Again, at face value, these should be interpreted as generally strong or conversely weak signals that value is going to be found elsewhere in the market. The next type of candle that we'll cover are Doji candles. Now, before everybody gets up in arms, if you've heard this definition before, technically Doji candles are those that open and close at exactly the same price. So I don't want to be misleading by calling these two Doji candles and this one also a Doji candle. But in practice, generally all three of these would be referred to as dojis. The important takeaway is that these candles represent indecision in the market. You failed to move higher or lower during the time frame, and clearly there was a fight between buyers and sellers. You will very frequently see this candle preceding a large directional move. So you see a doji here on this chart, several minutes later you dropped. You see a handful of doji candles here, and then again later on you dropped. That's because you're fighting between buyers and sellers, and eventually one of the two sides is going to win, and the resulting move will likely be much larger. The final single candle that we'll talk about is the hammer candle. Hammer candles form when price essentially sells back off after a strong move to close relatively close to the original opening price of the candle. So you can see right here on SoFi, this is a 5-minute chart. At some point, this candle, maybe 1 or 2 minutes before it closed, looked like a really strong up candle, but sellers sold it all the way back off closer to its opening price. This gives us a signal that potentially the market has changed its mind on what otherwise would have been a strong move in one direction. Potentially sentiment is changing, and you should be on the lookout immediately when you see this candle for a potential reversal. This is called an inverted hammer. You can see it here at the top right before a large sell-off. You get some regular hammer candles down at the bottom, and then ultimately a bit of a reversal. So it's a really strong individual signal that, again, potentially sentiment has changed. You can't take one individual candle and predict the future, but you should always be on the lookout for this kind of individual candle pattern. Before we move on to more complicated multi-candle patterns, I want to drop a quick word of warning in here on these 2 to 3 candle quote-unquote patterns. If you read a lot of different texts, you'll see a ton of different names such as tweezers, harami candles, bearish bullish sandwiches. The names go on in a never-ending stream. And personally, I think that takes a lot of the focus away from interpreting the auction process and what the market sentiment is, and puts it on just you kind of robotically memorizing these candlestick patterns and names. So, one example of this is off to the right on AMD here. A lot of books would call this a tweezer pattern, and it is kind of a reversal pattern. It does, I guess, kind of look like a pair of tweezers maybe, but instead of focusing on this and seeing this and saying, oh, it's a tweezer pattern, I need to do X, I want you to focus on the fact that in 2 15-minute time frames, sellers attempted to push the price lower and were rejected by buyers both times, right? So over the course of 30 minutes, you couldn't sell off. That alone is a good signal that you're probably getting ready to go higher, right? Not the fact that this is a tweezer pattern or any other, kind of 2-candle pattern, but the fact that the market sentiment is changing and these candles are showing you that it's changing. So quick note there, and then we'll move on. I also wanted to take a second just to quickly talk about volume, because at this point, you've probably noticed at the bottom of all my charts, you see these volume bars, and you might have been wondering, hey, why hasn't he addressed these? I've heard about volume. People talk about volume all the time. I'll just say volume is incredibly, just critically important to the trading process. And the entire next lesson, which is even longer than this one, is literally just talking about volume. So for now, focus on learning the basics of price action and really kind of trying to memorize everything that I've talked about in this presentation. And then in the next lesson, we'll get into volume. I'll answer all your questions about it. So with that, I want to get into multi-candle patterns and interpreting what I call the 4 C's of price action. When you're looking at multi-candle patterns and you're kind of viewing this as one picture, right? This one aggregate of all these individual candles that you just learned about. You really should be focusing, again, on what the market sentiment is and what this pattern or what this series of candles is telling you about the buyers and sellers and the auction process that they're undergoing. So instead of trying to teach you all the hundreds of different patterns that you can memorize, triangles, bear flags, bull flags, double tops, head and shoulders, all these different individual patterns that you'd read about in books, which are valuable. I'll admit, I think it's worth memorizing a few of them, and I go over them in the next slides. But, instead of doing that, I really want you to be focused on the fact that the market at any point in time is in one of these 4 cycles. And identifying which cycle you're in consistently will help you tremendously in predicting what might come next. So the 4 cycles are continuation, commonly referred to as trending price action, consolidation, which will hit on the idea of accumulation or distribution by large players, constriction, which I like to think of as kind of loading a spring or building pressure in the market, or capitulation, which marks a reversal or a change in trend. So with that, we'll get into each of these and go through them in detail. The first market cycle that we're going to talk about is continuation or trending price action. This is price movement that is clearly upward or downward in one direction. Typically it will move within a channel, and typically it will respect a moving average. More on moving averages in lesson 1.4. So in a trend, the market is consistently buying pullbacks and showing clear conviction that true value is higher. Or in the case of a downtrend, it's selling pullbacks and showing you that value of the stock is lower. Trends can be brought to an end by any of our following phases. You can see consolidation at the end of a trend, you can see capitulation that starts a trend in the opposite direction, or you can see constriction that ultimately explodes and creates a new trend either in the continuing direction or a reversal direction. So for now, the important thing to remember with trending price action is just that it respects a lower low, higher high pattern and ultimately is moving in one direction. The next cycle that we're going to talk through is consolidation. This is commonly referred to as ranges or channels. You'll also potentially hear it referred to as chop sometimes in the market. And typically it is following a strong move or the end of a trend and is defined as sideways price action in a pretty clear range. So if you look at forward on the daily chart here, you can see that it pretty much chopped between $21 and $19 for about a month and a half and kind of consolidated in this range. This happens for a few different reasons. Could be due to market indecision, so often you'll see consolidation prior to an earnings announcement or maybe an announcement from the Federal Reserve. Or it could be because a large player is either accumulating or distributing shares before igniting a new trend, either in the continuing direction or a reversal. I'm going to talk a lot more about accumulation and distribution in future lessons and how you kind of tell what's going on inside this range. But for now, just keep in mind that it could be any of those 3 things: indecision, accumulation, or distribution, and it'll typically follow, a trend, or it will be, right before a reversal in trend. The third price action cycle that we'll talk about is constriction. The 2 patterns most common here are triangles and wedges. Typically, they are identified, though, as kind of just a tightening price range. Triangles will typically have a flat top or a flat bottom, and then wedges, as you can see here on this chart, will typically kind of go in on themselves from both directions. Constriction in general can be thought of as kind of building pressure or loading a spring, right? Imagine with this triangle pattern here, imagine somebody that's under the water in a frozen lake, right? And they're trying to bust through the ice above them. They're constantly hitting this level, rejecting off of it, hitting this level, rejecting off of it, hitting this level, rejecting off of it. It's cracking, and then finally, at the end, you get this large explosion move out through the ice, kind of out through this top layer, right? that's what the market is doing. Buyers are convinced that price needs to go higher, but there's maybe a really large seller in the way, some kind of iceberg order that is holding them off, and they're retesting it over and over again until finally either the big seller that's at this level gives up, their entire order's filled, or a large enough buyer steps in that it just kind of blows through this resistance point. So this pattern, triangles and wedges and constriction in general, is very commonly followed by an extreme price move. But please note that it's not necessarily in the direction that the constriction is happening in, right? Like if you look at this wedge type pattern, at the very end here, you actually kind of tried to break up through and then failed. And that exhaustion and that failure can also move the price extremely fast in the opposite direction. So generally speaking, again, constriction, try to imagine somebody, trying to break through the ice in a frozen lake, trying to build pressure until you get this explosive move in one direction or another. The final market cycle that we're going to cover is capitulation. And I'm going to talk about it in 2 slides and cover 2 of kind of the most common reversal patterns that you'll see. The first is the double top pattern or the double bottom, and the second on the next slide is the head and shoulders pattern. In general, capitulation is kind of marking the top of a trend, right? It's this reversal, this climactic change in market sentiment that is going to send price trending in the opposite direction. Again, the important thing to note is not the name of the pattern, right? It's not, oh, there's a double bottom pattern and so price must reverse, right? Instead, what's important is that you think about what the participants in the market are feeling, what the overall sentiment is and how it is changing, right? And so to use an example on Netflix, you can see, you came into this like 690-ish price range, right? You've been in a strong uptrend until then. So just to show you that, again, you've been in a strong uptrend. You failed off of this level here. And then participants in the market, maybe some of them got in up here and now they're negative down here, but they think, okay, well, I'm in an uptrend, it's okay. More participants also would have gotten in right here because this is kind of a pullback in a trend and they think it's going to continue and keep going up, right? But at this point, this second top and this second failure, what's going to happen in the market, right? People are going to start bailing. The people that bought here are going to take profit. The people that bought up here are going to start panicking because now they're going negative on their position again. And so all of that combined selling is going to ultimately lead to this double top pattern and the continuation in the opposite direction. So again, don't think about, oh, it's a double top pattern, price is going to reverse. Think about the participants that are trapped there, right? Think about the participants that are taking profit there. Think about what longer term time frame and shorter term time frame participants are thinking. And that is really going to help you identify when the reversal will actually take place. Now, how significant the reversal will be is going to depend on many factors that we'll talk about in the future. Volume, how long the trend's been going, are you running into a major support resistance level? A ton of different stuff can go into this, but for now, again, the first capitulation pattern is the double top and double bottom, and we'll talk about head and shoulder next. The second pattern that we'll talk about for capitulation is the head and shoulders pattern. This can be a little bit trickier to pick out, in my opinion, than the double top pattern, but it does happen more commonly on lower time frames, which again is great for us intraday traders. But just to show you that it happens on kind of all different time frames, I've shown a daily chart here and on AMD a 15-minute chart. So the important takeaway, again, is what is this telling us about market sentiment, right? Not that this is a head and shoulders pattern, but what is this telling us about the participants that are taking place in the market auction? You have participants that are hitting this resistance point here, right? So if I get my little pin back out, you have a perfect triangle constriction range, right? So you have participants that are trying to break out of this triangle that ultimately do break out. People then sell at the top. Maybe you have short sellers coming in here, and then price fails back down into this level. And then this second retest of this shoulder is the most important part, right? Because at the second test of this shoulder, you have people that bought in here that took a little bit of profit and now are kind of thinking, okay, I'm going to take the rest of my position off the table because I think it's maybe not going to go any higher. You have participants that got really unlucky and bought in up here, right? Because they were FOMOing this original breakout. And so they got in up here. And now they're thinking, oh man, I just need to get out of this position. I'm red from up here, but at least, I'm not as bad as when we were down here, right? So you've got both of those people thinking, okay, I'm just going to sell. Then you have a third group of short sellers, and short selling is a concept that we'll get into in future lessons, that are coming in and pushing the price even further. And so you get all three of these groups here, right? Selling, 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 and then you get a kind of capitulation move and a reversal in price. Same thing happens on the reverse side on AMD, right? Where you get kind of this, again, this double test of this level over here and then a strong move in the opposite direction. So think about what the market participants are doing. Think about who is trapped in a position, who is getting out of a position, who is coming in and short selling. Think about all of those factors and don't focus as much on this is a head and shoulders pattern, therefore price must reverse, right? Kind of that robotic pattern recognition is not going to do you a lot of good in the long run. Okay, so now that we have talked about the 4 C's of price action, I want to briefly introduce the concept of multi-timeframe analysis. This is a super important topic, and we're going to cover it a lot more in future lessons. But the main takeaway is that you always need to take your trade within the context of the higher time frame. Generally speaking, the higher time frame, the more significant the pattern, right? So a double top pattern on the daily is typically more significant than, say, a double top pattern on the 1-minute chart. And the reason it's more significant is because you have a lot more participants taking place in the trade, right? You don't just have day traders, you have hedge funds, you have long-term retail traders that kind of believe or don't believe in the future growth of a company. So when you are taking these intraday trades, you want to kind of quote-unquote check your mirrors before taking the trade, right? You want to glance at what the higher level time frames are doing before getting into a trade. And I've chosen this set of charts of CCL because I think it perfectly highlights why multi-timeframe analysis is important and how it can really save you a lot of pain. So if you were looking at Carnival Cruise Lines in the pre-market on this day, and the market opened and you saw this huge up candle on the 5-minute chart, you would be thinking, hey, Carnival Cruise Lines is a buy. This is, a super strong bullish candle. I'm going to play it for an opening range breakout, right? So in the end of this 5-minute candle, I'm going to buy for a move higher to, say, 24.50. If you didn't look at the daily chart, though, you would have been super disappointed because on the daily chart, this move was actually right into a resistance level, right? You're in a consolidation, and the more likely situation is that you're actually going to reject off of this level. And so you essentially would have bought like right around here, and you would have bought directly into a resistance level, which it touched, and then reversed off for the entire rest of the day. And you would have essentially gotten stopped out more or less immediately on this trade. So again, hopefully that highlights the fact that you need to at least briefly look at what's happening on the higher time frames before initiating a trade based on the lower time frame patterns. The last topic that I want to cover with you guys today is the idea of support and resistance. This is one of the most important concepts in day trading because a ton of different setups and scalps and different day trade strategies involve either the acceptance or the rejection of these support and resistance levels. Generally, support and resistance is defined as a price level that has been tested multiple times and therefore will become an area of contention between buyers and sellers when it is retested in the future. The most important thing when thinking about support and resistance lines, and I can't stress this enough, is that they should be easily identifiable by anybody that is looking at the same chart, right? If you're drawing a line that nobody else is drawing, then nobody else is going to be trading off of it, right? These levels work in part because they're a little bit of a self-fulfilling prophecy. And so if you see this area of resistance, chances are millions of other traders are also seeing that area of resistance and they're making trades off of it. So I have got a couple of key concepts on the following slides, but that's just a brief introduction. So here I've highlighted the 4 key concepts of support and resistance. I have a slide on each of these following to show just a quick example, but the first concept is around market psychology. And here, again, I've been stressing through this entire presentation that you need to think about what the market sentiment is and what participants are doing. And these support and resistance levels become support and resistance, and they work for really 2 main reasons, right? The first is that past participants have purchased the stock at this level, right? That's important to remember. When the level becomes support, it is often because larger participants still consider that level to be fair value and will step in to purchase more, or because new participants see that level and decide that it's a fair area to enter a trade for the first time. The second thing, which I talked about on the previous slide, is that these levels can be self-fulfilling prophecies. Because each of the market participants can see them and everybody can draw these lines on their chart, a ton of different people will step in and make trades at that level. So that's concept 1. Concept 2 is about rigidity, or a lack thereof. These levels should not be trusted in most situations to hold exactly to the penny, but instead you can think of them kind of as a trampoline. The price will push below and be bounced above, or vice versa. Concept 3 is that support becomes resistance, and resistance ultimately becomes support. Once a price level breaks out of a resistance, it will often retest that resistance level, which will then become support and be retested in the future. And I'll explain that again in an example on following slides. The last concept is the strength of support and resistance is really a function of volume and time. This is going to be talked about mostly in future lessons because we haven't covered volume yet, but generally speaking, levels that are closer in time to you and have had a higher volume transacted at that level are stronger than those further back in time with very little volume. So with that, let's get into some examples. So we already talked about the market psychology on the previous slide, so I'll jump into concept 2 here and talk about rigidity or lack thereof. So this is just an example of that concept. I said before, levels should not be trusted to hold to the penny, and you can see on this chart clearly these lines that I've drawn are support and resistance, but they are definitely not to the penny, right? If you think about this line here, it was tested here, it was tested here. Both times it kind of rejected. If I draw a line up here at $125.06 on AMD, you can see that it was tested pretty much to the penny here, but then it went through it and rejected here, and then tested it many more times throughout the rest of the session. So please do not trust these levels on your chart exactly to the penny. Sometimes there's good reason to think that they will hold exactly to the penny, and you can play them like that, but generally speaking, understand that support and resistance is a little bit more squishy than a truly hard concrete line. All right, so the last concept that we want to talk about today for support and resistance is that support often becomes resistance, and resistance often becomes support once these levels have been broken through. So if you look at this daily chart of Facebook, I've drawn a couple of orange lines that are meant to represent support and resistance. And on this first line here at $246, you can see that price tried to break through this and ultimately did and gapped up. It then retested it, so resistance has become support. It retests it here, it retests this all the way down in January, and you can see the same thing happening with all of these other lines that I've drawn on the chart, right? This one up here, price rejected off of it multiple times in the past and then was retested here. So this idea is super important because it can really keep you from having this fear of missing out emotional reaction when the price gaps up or when it launches through a level that you've been watching. Because at the end of the day, as you can see here, you can pretty much always just wait for it to retest the level, right? Sometimes it won't retest the level, it'll just keep on going and you'll miss the trade, and that's okay. But a lot of times, you don't have to be the very first person in. You can wait for this gap, wait for it to retest the level that was resistance, that is now support, and then you can take a trade off of that new level. So That's the final topic we'll talk about on support and resistance, and the next slide I have a few closing comments. So to close out today's course, I just want to leave you with two quick thoughts. The first is that the candlestick patterns that we discussed today are just one part of the equation, and you should really never trust them purely by themselves. The second is that all of the techniques that you learned today need to be practiced. If you don't have a platform where you can practice these yet, you can go to one of these two websites as a good free resource and start just looking at charts and getting a feel for recognizing support and resistance, for identifying patterns, and for really learning all of the different elements that we discussed today. Finally, if you guys found this video helpful, please leave a thumbs up. If you have any questions about the material, just leave a comment down below and I'll do my best to answer all of them. And if you want to see more content like this in the future, please subscribe to the channel. Thanks for watching and have a great day.